Hi, this is Matt Green, taking the Accounting 6320 class, and this is my formal presentation. My topic is the Sarbanes-Oxley Act of 2002. As a way of introduction to SOX, I'd like to talk about the three aspects that the paper asks. The first is why it was enacted. It was enacted in response to some very large business failures in the publicly traded business community. Next, SOX is an act passed by Congress into law and signed by President Bush on July 30th of 2002. It created a new oversight board to make sure accountants, auditors, CEOs, and CFOs are aware of all that's going on within a business. It establishes new penalties for currently defined crimes and also adds new crimes that can be committed in conjunction with accounting fraud. And last of all, I'd like to discuss whether SOX is working or not. There are arguments for both sides, obviously, and I contend that it did not prevent one of the largest frauds in history, is that of Bernie Madoff, and I'll talk about that there. Finally, I will talk about my thoughts and feelings on the Sarbanes-Oxley Act. On June 26, 2002, WorldCom reported that it had overstated its earnings, its income, by over $3.8 billion. It ended up totaling over $11 billion. Enron filed for bankruptcy just 6 months after that, or 6 months before that, in December of 2001. And Arthur Andersen, the fifth largest accounting firm at the time, was forced to close its doors because of its involvement there, and because of the fraud that was perpetrated at Enron. These and other fraud problems caused lawmakers in the U.S. to create and approve SOX. Bush signed the bill only a little over 30 days after WorldCom's collapse, which seemed to be rushed. At the time of the collapse, there was little oversight in the accounting profession, which was thought to be self-regulating. Obviously, this setup was not sufficient to protect against multi-billion-dollar frauds, because people are sometimes swayed to do things that are illegal and unethical. Obviously, SOX contains many important provisions, sections that could be discussed, but because of time constraints, I'll only mention a few that I felt were the most important. Of course, we'll start with Section 101, where the Public Accounting Oversight Board, who oversees the registering and disciplining of accounting firms, was created. They oversee and discipline accounting firms to prepare audit reports on public companies. They establish auditing and accounting standards and conduct inspections and investigations of registered accounting firms. Section 202 deals with the lack of auditor independence, which was previous to SOX being enacted. It gave this board the ability to make sure that the auditors are independent from business management. Section 301. This section requires that public companies have audit committees that will take charge of the audit and selection of auditors within the company. Obviously, they need to be independent of management again. Also establishes new procedures for whistleblowers and how they are dealt with, and protection for them. Section 302 and 906, these are considered to be some of the most controversial sections, as they mandate that the CEO and the CFO of a publicly traded company have to certify to the truthfulness and accuracy of the financial statements. This means that they are required by law to be very involved with the process. Some of the large complaints here is that it's timely, that it's costly, and it makes CEOs and CFOs' attention drift away from perhaps running the company like they should, making sure that they are involved in the financial process. Section 404 is another controversial section that requires internal control reports and assessments of annual reports to be included in the annual reports of all publicly traded firms. As of 2008, smaller firms were required to participate in this. It's controversial because of the significant cost of hiring outside auditors and accountants to oversee this process. Section 601 and 901 authorizes increased penalties for existing laws and creates new crimes in conjunction with wire fraud and other white-collar crimes. Some arguments in favor of SOX, as the fact that virtually no other public failures have happened in publicly traded companies, that it has increased investor confidence, shown by a stock market that has almost doubled in the 5 years following SOX enactment. Although I don't necessarily think this is because of SOX. There are other drivers of that, and I don't think we can give all the credit to that simply because if SOX was working, our stock market would still, in this right, the stock market would continue to be climbing, and it currently is not. Some arguments against SOX include just the fact that it did not stop the fraud and failure of the Madoff Ponzi scheme, $50 billion. Mainly this is because it was not actually regulated by the Public Accounting Oversight Board, and perhaps some of these things should have been considered when they were doing that law. And another argument, The Economist magazine, which I quote in my report, argues that it was passed too quickly and written shoddily, and it's very costly for smaller firms. And so it's important that we look into those. My thoughts of the Sarbanes-Oxley Act of 2002: on one hand, I can see the need to have SOX to protect the people of the United States. After all, protecting the people is the responsibility of the federal government, and I think it applies to more than just physical protection, financial protection, things like that. I can see that the need to rein in those who would do damage to investors, as I myself invest in companies and rely on their financial statements to make important personal investment decisions. Again, on the other hand, I never like when the government gets involved in business because I feel like they never do a fair job without hampering free trade and hurting the economy. Perhaps this is necessary it's a necessary trade-off that's required to protect people's money and their investments, their future retirement funds and things like that. Obviously, constant improvement can occur with this act over time, and the only way to see if Sarbanes-Oxley is working is to give it some, we'll just see what time tells. If we have any more large accounting frauds in publicly traded companies, one thing they can work on probably is seeing if they can include privately traded firms and funds that may be over a certain limit, and so that may be something they can consider. Anyway, I appreciate the chance to do this paper and learn more about Sarbanes-Oxley Act, and that is the end. Thanks.